Welcome to the Deep Dive, your shortcut to being truly well-informed. Trying to make sense of complex financial reports, especially for these really high-profile, fast-moving tech companies, it can feel like a real chore.
Absolutely. It's like information overload sometimes.
Exactly. So that's where we come in. We take all that raw material, the earnings releases, the market data analyst takes, and boil it down to what you really need to know. Today, we're taking a deep dive into Supermicro Computer, ticker SMCI. We're looking at their Q4 fiscal year 2025 earnings, the quarter ending June 30th, 2025.
Right. A really closely watched one in the AI space.
Definitely. Our mission here is to get past the headlines, really understand how the company performs, see what the market thought, and figure out what it means for this key AI player. We'll use our 5-part framework to cut through the noise.
And that framework is so important because, look, the official numbers are just one piece. You have to see them against what the market was expecting and how things are actually playing out in real time. It helps put it all together.
Okay, let's get started then. First up, the immediate reaction and the big picture with slide 1, the at-a-glance scorecard. So this first slide is really that high-level snapshot. How did SMCI stack up against Wall Street estimates? And maybe more importantly, how did investors react right away?
Well, it was definitely a mixed bag, leaning negative, I'd say. You had continued growth, which is good on the surface, but they fundamentally missed on key expectations.
Okay.
And for a company like Supermicro in this hot AI sector, the market price is in near perfection, so even small misses can hit hard. Specifically, revenue was $5.8 billion.
Right.
But Wall Street was looking for something between, say, $5.89 billion and maybe $5.99 billion. Not a huge miss percentage-wise, but significant given the context.
And earnings too, right? That didn't quite hit the mark either.
Correct. The non-GAAP diluted EPS, which is what analysts focus on most, came in at $0.41. The consensus forecast was around $0.44.
Okay, so below expectations there too. And the GAAP number.
The GAAP diluted EPS, that's the official accounting number, was $0.31 per share.
So, revenue miss, EPS miss, how did the market take that news?
Not well. Not well at all. The reaction was pretty swift and definitely negative. Reports showed the stock dropping sharply, somewhere in the range of like 10% to maybe even 16% right after the numbers came out.
Wow.
Yeah, it really highlights that disappointment and maybe growing unease about profitability.
Analyst sentiment shifted quickly too. Lots of talk about shrinking margins, maybe growth slowing down, pricing pressure, those kinds of concerns.
And you can see why when you look at the core numbers themselves. They are pretty stark, actually. Total revenue, as you said, $5.8 billion, which is up 7.5% year over year. So growth,
Yes.
but the net income just plummeted, down over 34% to $195 million. And diluted EPS, that GAAP number, fell almost 33% to 31 cents.
That's the real story of the quarter, I think. That widening gap between the top line sales and the bottom line profit. Revenue grew, sure, but the profit fell off a cliff.
Yeah.
Tells you the cost of getting those sales went way up.
They're making significantly less profit for every dollar of sales compared to last year. And what's really telling, like you said, is that diluted EPS fell so hard, 32.6%, even though they actually had fewer shares outstanding this year compared to last.
Oh, interesting. Usually fewer shares helps EPS, right?
Exactly. It should provide a bit of a boost. So for EPS to fall that much, despite a lower share count, went from about 642 million down to 625 million, it just underlines how severe that 34% drop in net income really was.
Okay, that really paints a picture. Let's move on then to slide 2, the engine of profitability. So this section is where we try to understand why. Why did profits fall when sales were still going up? We're talking about a double squeeze here, right?
That's a good way to put it, yeah, a double squeeze. First, you had gross margin compression. Their official GAAP gross margin for Q4 was 9.5%.
Okay.
That's down from 10.2% in the same quarter last year. So for every dollar of servers or systems they sold, they kept less as gross profit.
And why would that happen? More competition, higher costs.
Likely a mix of both. The AI server market is getting crowded, putting pressure on prices, and they probably faced higher costs for components, maybe supply chain issues. They even mentioned dealing with tariffs and regional costs, which hits that cost of goods sold line directly.
Okay, so that's squeeze number 1. What was the second part?
The second squeeze came from operating expense expansion. Their total operating costs, things like R&D, sales, administrative stuff, surged. They jumped 22.6% year over year.
Wow, 22.6%. And revenue only grew 7.5%.
Exactly. Operating expenses grew nearly 3 times faster than revenue. And the biggest chunk of that increase, it was research and development, R&D. That spending leaped by a massive 43.7% to over $183 million.
Okay, that's a huge jump in R&D. Is that a strategic move?
Almost certainly. It looks like a very conscious decision to invest heavily, maybe sacrifice some profit now to stay ahead technologically, innovate faster than the competition in this AI race.
Makes sense, but the combined effect.
The combined effect of lower gross margins and those soaring operating costs really hit their operating income, the profit from the core business. It fell over 20% to $228 million. And the operating margin shrank from 5.4% last year down to just 4.0% this quarter.
So only 4 cents of operating profit for every dollar of sales, down from 5.4 cents.
Precisely. A significant contraction.
Now, you mentioned GAAP figures, but analysts often look at non-GAAP. Can you quickly clarify the difference for listeners?
Sure. So GAAP numbers follow the official standardized accounting rules. Non-GAAP figures are adjusted by the company's management. They typically exclude certain expenses they feel aren't part of the core ongoing business operations.
Like stock-based compensation, maybe?
That's a very common one, yes. In this quarter, Supermicro excluded about $83.6 million in stock-based compensation, or SBC, to get to their non-GAAP results. So the non-GAAP net income was higher, $260.7 million, giving that $1.41 EPS we mentioned earlier.
Compared to the GAAP net income of $195 million and $0.31 EPS.
Right. But the key point is, whether you look at GAAP or non-GAAP, the trend is the same. A significant decline in profitability compared to the prior year, despite the revenue growth. That margin squeeze was evident across both measures.
Got it. Okay, let's move to slide 3. The engine room business segment performance. Usually, this is where we'd look for details on which parts of the business are driving growth or facing pressure. AI solutions versus storage, maybe, or different regions. But this quarter's report was a bit different here.
It was, yeah. Quite notably, the actual press release for Q4 FY 2025 didn't give us that quantitative breakdown.
Really? No numbers by segment or product line?
Nope. No specific figures for AI solutions or storage or their 5G edge stuff. Nothing broken down by geography either.
That's unusual, isn't it? Or maybe less common.
It can happen, but yeah, it definitely limits visibility. Usually, that kind of detail gives you really crucial clues about where the strengths and weaknesses are. Is AI growth offsetting declines elsewhere? Are certain regions struggling? Without it, we have to rely more on the aggregate picture and management commentary.
Interesting. Okay, well, let's move on then to slide 4, financial strength and shareholder rewards. All right, so this is where we look beyond the quarter's profit and loss and check the company's overall financial health, the balance sheet, cash flow, how they're managing their capital. And it sounds like there's been a big shift here, a kind of high-stakes transformation.
Absolutely. Dramatic transformation is the right word. You look at their balance sheet compared to a year ago, and it's clear they're pursuing a very aggressive strategy to scale up, likely for these huge AI projects.
How so? What changed?
Well, the most striking thing is this simultaneous explosion in both cash and debt. Their cash on hand more than tripled. It's now $5.2 billion. That's a huge war chest.
Wow, $5.2 billion in cash. Where did that come from?
Mostly from issuing new convertible notes and selling more stock. They've raised a lot of capital, and they needed to fund big inventory buys and expand manufacturing capacity for these potentially massive data center orders.
But you said debt exploded too, so they borrowed a lot.
They did. Total debt, including those convertible notes, more than doubled. It's up to $4.8 billion now.
Okay, so cash up, debt up, almost mirroring each other. What does that do to their risk profile?
It definitely increases financial risk. A key metric we look at is the debt-to-equity ratio. That jumped from 0.40 a year ago to 0.75 now. It basically means they're relying much more heavily on borrowed money to fund growth. It's a fundamental shift towards a more aggressive, maybe higher risk, high growth strategy.
So leveraging up for growth, but are they generating cash from the actual business, despite the profit drop?
Yes, and that's a really important positive point. Their cash flow from operations was strong in the quarter, $864 million.
Okay, that's good.
It is. It shows the core business is still very effective at turning sales into actual cash, even if the accounting profit is down. That provides really crucial financial flexibility.
And are they returning any of this capital to shareholders? Dividends, buybacks?
No dividends, but they did repurchase some stock. Looking at the full fiscal year 2025 cash flow statement, they used $200 million for stock buybacks. So returning some value that way by reducing the share count over the year.
All right, good context on the balance sheet. Let's move to our final section. Slide 5, the road ahead management's outlook and key takeaways. So this is where we put it all together. The results, the commentary, and crucially, what management is forecasting for the future. And you called this a tale of two forecasts. Sounds intriguing.
It really is quite a contrast. On one hand, you have CEO Charles Lang sounding very optimistic in the commentary. He's emphasizing their progress, their leadership in AI solutions, that impressive 47% overall growth for the full fiscal year 2025.
Okay, the long-term picture sounds positive.
Right. And he specifically mentioned a strategic goal,
Yeah.
expanding their roster of large-scale data center customers from 4 in the fiscal year that's just ended to maybe 6 to 8 in the upcoming fiscal year 2026. So aiming for bigger, more significant deals.
There's a contrast, you said. What about the actual near-term guidance?
Exactly. The formal guidance for the next quarter, Q1 of fiscal 2026, was more cautious. They projected net sales between $6 billion and $7 billion. That's potentially growth. But the non-GAAP diluted EPS forecast was only between $0.40 and 52 cents per share.
40 to 52 cents. How did that compare to expectations?
It fell short. The analyst consensus heading into the report was around $0.59 per share. So guiding below that signals those margin pressures we saw in Q4 are likely to stick around in the near term. And that EPS guidance miss was definitely a key reason for the negative stock reaction.
Okay, so near-term caution, but then what's the other side of the tale of two forecasts?
The other side is a long-term guidance, specifically for the full fiscal year 2026. Here, they were much more bullish. Management guided for net sales of at least $33 billion.
$33 billion. Wow. How does that compare?
That was significantly above what analysts were forecasting, which was closer to maybe $29.8 billion on average. So it's a huge target. They're basically saying, yes, we have some near-term margin headwinds, but look past that the long-term opportunity is massive, much bigger than you think.
That really is a paradox. Near-term pain, long-term super gain. It puts investors in a tough spot.
Absolutely. Do you focus on the immediate challenges and the disappointing profit outlook for the next quarter, or do you buy into that very ambitious long-term vision? It requires a significant amount of faith in their execution down the road.
Okay, let's try to summarize the key takeaways from this whole deep dive. What should listeners really remember?
I think there are 4 main points. First, we called it a high-growth hangover. Despite decent revenue growth, they missed elevated expectations, and the market punished them for it. The easy wins might be over.
Okay, hangover.
Got it. Second, the margin squeeze is real and multifaceted. That double squeeze we talked about, pressure on gross margins from competition and costs, plus those surging operating expenses, especially R&D, it's hitting profits hard.
Right, the double squeeze.
Third, a paradoxical forecast signals a strategic pivot. That clash between the cautious near-term guidance and the super ambitious long-term target. It suggests they're asking investors to endure short-term pain for long-term leadership, a strategic choice.
Okay, paradoxical forecast.
And the last one, finally, building a fortress balance sheet for a bigger war. They've aggressively raised cash, but also taken on significant debt. It increases risk, but it's arguably necessary funding for the immense scale required to compete for those giant AI infrastructure deals.
Fortress balance sheet. Okay, those are great summaries. So what's the final narrative here? What's the ultimate story this quarter tells us?
I think this quarter was a reality check. For Supermicro and maybe for the broader AI hardware space, the demand is still clearly strong. That underlying AI trend is real. But the Q4 results show that growth isn't easy or cheap anymore. You've got intense competition, rising costs for innovation. It's leading to this painful margin compression. Management says they're investing strategically, sacrificing near-term profit for long-term dominance, building scale, focusing on R&D. That's the narrative.
But the market's reaction?
The market's reaction shows investors are shifting focus. After a period of huge optimism, they're now demanding proof. Not just promises of future growth, but tangible evidence of profitable execution right now. So the story isn't just about growth anymore. It's about the very visible cost of that growth.
That's a really clear takeaway. So stepping back, what does this deep dive into SMCI mean for you, our listener? It's more than just one company, right?
Definitely. This is really a window into the dynamics you see in many high-growth industries. Think about that balancing act.
Yeah.
How does a company push hard for innovation, for market share, while also managing profitability today? When you look at other fast-moving sectors, maybe EVs or biotech or other tech areas, do you see similar trade-offs? Companies sacrificing margins now for a shot at dominance later. It gets you thinking about that cost of growth for anyone aiming for the top spot in a tough market.
That's a great point. What really stands out to you from this deep dive? Something to reflect on. Okay, before we wrap up, just the usual reminders. This deep dive is purely for informational purposes. It is absolutely not financial or investment advice.
Please, always do your own research.
Yes, and consult with a qualified financial professional before making any investment decisions. Also, just a note that this report was generated using an artificial intelligence model, integrating data from Supermicro's official earnings release and publicly available market data. While it's designed for accuracy, you should always seek independent verification. Like and subscribe to stockanalytics.ai. YouTube channel, members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.